finance, but from a very broad perspective, the type of thing you want to go out and buy yourself. And in that regard, I'm very happy to have Dan Davies with us today, who has written this truly excellent book, which now has an American publisher. It's been out in the UK a little while, but it's coming out here with Scribner, which is a Simon & Schuster imprint in March 21. And the book is called Lying for Money, which is just a fantastic title in and of itself. But more importantly, how legendary frauds reveal the workings of our world. So I'm really looking forward to having this conversation. It's a fabulous book. Dan's going to take over the screen shortly. We're all Zoom experts now, so you know what's going to happen, right? So Dan's going to take over the screen for the next 20 minutes and talk to us, give us a few slides, etc. In the meantime, if you have any questions, two ways to do this. If you're on Zoom with us as an attendee, just put it straight into the Q&A function. If you can't find that, use the chat function or whatever, right? But Q&A. If you're watching live on YouTube, hi to everybody on YouTube, what to do is put it into the comments there, and then we've got someone watching those comments, and they can then jump those and put them into the Q&A for us. Start asking questions as early as you can, and that way we can get through more. And we will run for an hour and we'll go from there. So without further ado, I'd like to welcome Dan. A little bit of background on Dan. Dan is head of research at Frontline Analysts, a Bangalore-based credit and risk management firm. He's also a former bank regulator and an investment banker who now investigates global economics and finance for consultancy clients and writes books and articles for the general public. One thing about Dan, he's a vociferous Twitter user. And I learned a lot from him during the financial crisis because he was one of the few people that actually knew what was going on. So he was a wonderful resource. He also used to run this brilliant newsletter called Predicto, which was very, how can I put it, very provocative. Because most people won't put their bets out there on things. And the whole of Predicto was based around Dan saying, here's a bunch of stuff that's happening in the world. This is going to happen. Here's why I think it's going to happen. And if I'm wrong, we can talk about it afterwards. So I always appreciated his honesty. And that's what comes across in the book as well. It's an unvarnished look at why, and I don't want to give too much away, but why basically finance and fraud are necessary bedfellows. You can't really have one without the other. And with that, I will hand over to Dan. Thank you.
Thanks very much for that extremely generous introduction, Mark. I'll just move my slides onto the screen and move to presenter view for myself. Basically, I've got not too many slides here. I'm going to go through what I think are the key points of the principles of what I'm talking about. Half the book is kind of stories and fascinating facts about famous frauds from history, but I think it's important to put these things into a theoretical framework because that's how I first got interested in this whole subject. I started my career in bank regulation back in 1997. I was never a bank supervisor in the sense of actually doing on-site visits and ticking boxes. I was meant to be one of the economic advisors to the supervisors. And I joined while the Bank of England still had scars on its back from a fraud called BCCI, which you have to be quite old to remember now, but suffice to say, its nickname was the Bank of Cocaine and Conmen International, and that's pretty much what it was. And more or less my first job while I was at the bank was to look through past inquiries and House of Commons Select Committee reports into massive failures in the financial system and see if there was anything they had in common and anything that could be done about not necessarily stopping them, but making sure that the Bank of England was not so clearly blamed for them. While I was working on that, I began to notice that the office next door to me was getting somewhat busier, that more and more important people were coming in to visit it, and that the staff there was staying later and later. And, you know, as a kind of young 20-something, I was going, oh, wonder what's going on there. And it turned out that what was going on there was the collapse of Barings Bank, which was one of the first big rogue trader scandals of the golden decade for rogue traders of the 1990s and early 2000s. I ended up getting drawn into the eventual inquiry into that one as well. As a result, I wrote what remains my first and only journal publication, which is an article called Risk and Remuneration, describing how the bonus systems of investment banks incentivize risk-taking. It's actually now so out of date that they've changed the name of the publication it appeared in. Also, it's not really worth looking up because I don't necessarily believe it anymore. It's the standard explanation of why bankers take risks, which is that they get all of the upside and none of the downside. And so therefore that gives them an incentive to take bigger risks. The more I've gone on in my life, the more I end up thinking that that is actually an extremely poor explanation of why these things happen, because at the end of the day, the downside is you don't have a career anymore. The downside is huge. If the balance of risk and reward doesn't really work that way. And why, as I ended up getting more and more dissatisfied with this explanation, I ended up realizing that fraud and dishonesty, for reasons that we'll discuss on the next couple of slides, just don't fit very well into a conventional economic framework. As I kept on talking about these things, I ended up realizing that I couldn't really explain any of these phenomena in the conventional framework, but nor could I explain them in any other framework, and nor was I able to shut up about them. Which was kind of career limiting. And after a few years, me and the Bank of England decided that we would seek success in separate avenues. I went into investment banking, and it turned out to be reasonably profitable for me, because when banks screw up, they tend to screw up badly. When they screw up badly, their share prices move a lot. And so I ended up carving out a still small but pretty profitable niche, but I think I was the first guy to do it, to seriously analyze bank regulations and court filings in order to analyze what they call operational risk, but it's basically misconduct risk. It's the very large risk that banks take that one of their employees is doing something against the law, and that this will end up causing costs out of all proportion to almost anything else that goes on in the bank. So I was there for RBS. Me and Fred Goodwin had to suffer ourselves, and then me and Sir Fred Goodwin had to suffer each other for a while, and then he became Fred Goodwin again, and our paths diverged. I was there for the Lloyds Bank payment protection insurance scam, which was something we might talk about later in the Q&A, but it was one of the great mis-selling scams of British banking, which involved the fraudulent selling of something somewhat more than $50 billion worth of insurance products to British customers, and which has taken the best part of 20 years to sort out. And I was there for the UBS tax evasion schemes, which again metastasized. So there's also various Swiss sanctions busting schemes. All of these things I had a front seat. Very few of them I really understood how bad they were going to be, because it's actually quite difficult to understand how bad a fraud is while it's going on, because there are huge incentives to remain in denial. It's the psychological barriers to actually making that switch in your mind from here are some business practices that I don't like to actually saying someone's going to jail for this. If you're not in the law enforcement profession and you don't see that every day, it's quite difficult to make that switch to regard another human being as a criminal. But anyway, that's my own background. I'll pass on to the next slide now for what I think are the 3 or 4 most interesting points about fraud considered as an economic entity, because fraud is interesting in kind of many ways. Economists don't understand it well because it's a criminal phenomenon. Criminologists don't tend to treat it all that well, partly because they don't always grasp the economic aspects of it, and partly because fraudsters are not like other criminals. They are not, in the attractive sociological term, deviant people. It's interesting that white-collar crime is the only form of crime in the literature that's identified not by the act itself, but by the kind of person who carries it out. White-collar criminals are people like you and me, or like Mark and me, anyway. They're respectable middle-class people, and if you go into criminology, it's not always because you're terribly interested in boring suburban clerks and accountants. But anyway, as an economic phenomenon, I've got 4 points on this slide. Fraud is a crime that intrinsically involves time. This was something that J.K. Galbraith, who's one of the few economists who's written good stuff about fraud, said. He untruly claimed that it was interesting to economists. That's just not true as a statement about economists. They tend to ignore it a lot because it's got a time parameter. You don't know that a fraud has taken place for quite some while. This is why fraudsters, unlike other kinds of thieves, don't have a problem fencing their stolen goods. If you've stolen a BMW by just taking it off the street, then the owner will be on the lookout for it immediately, and you've got to hide it or move it before you can sell it. If you've stolen a dozen BMWs by buying them on credit that you don't intend to pay back, then the person you've stolen them from will expect to see them on your forecourt lined up and ready to sell, because he doesn't know that he's been the victim of a crime yet. In that interim period, there's a general increment to what Galbraith called psychic wealth, because the thief knows that he's stolen the goods, but the person who's been thieved from doesn't necessarily know that they've lost them. Second interesting point about fraud that we'll kind of get into, in many ways, the management science literature is more interesting to look at when you're thinking about fraud than the economics literature, because management is all about information, and fraud is a crime which can't happen in a full information environment. This is one of the reasons that economists tend to work away from it. Companies are always run on the basis of a reduced version of reality, because for any business that's bigger than selling eggs from a farm gate, you can't take into account all of the things that are going on. Fraud is relying on that representation allowing for error, and it's relying on that representation allowing for someone to misrepresent a version of reality. As Leslie Payne, the crazy accountant, said, a safe that's been blown up open can't be passed off as a safe that the accountant lost his temper with, but stealing things through fraud doesn't have that self-limiting factor. Your person gives you the goods, even though he might later wish that he hadn't done. One specific kind of management technology that people use is audit and checking. But audit and checking are expensive. Trust is cheap. And that's why fraud happens, because you can't check everything. Every decision to check up on something is effectively a decision on what you're not going to check up on, and the rest of the thing is trust. In the book, I described something that I call the Canadian paradox, partly because while writing the book, I was ripped off by some Canadians, and partly because it is a thing. Canada is famous for stock exchange fraud. Canada is an incredibly high trust society, but it has the old Vancouver Stock Exchange, which was the fraud capital of the world. It has the Canadian reverse takeover fraud industry, whereby people still rip off the investing public with worthless Chinese companies listed on Canadian exchanges. It's got mining frauds like you would not believe. It's a high fraud place, but a high trust economy. You can contrast that to somewhere like Greece, a great example of a low trust society, well known to be so. But in Greece, Greek ship owners will do $1 million deals on the basis of a handshake. What's going on there is that in high trust societies, you can generally assume that someone with a suit and a decent line of talk is going to do what they say they're going to do, and they're not going to steal the money. In somewhere like Greece, you only do business with people who you know and whose families have been doing deals with yours, since well back before the birth of Christ. It's the paradox that fraud is an equilibrium phenomenon. The same patterns appear over and over again in places widely separated in space and time, but it's not a single equilibrium. You can have high trust, high fraud, as well as low trust, low fraud economies. Greece and Lebanon in particular has an extremely low incidence of fraud carried out by anyone other than the government, simply because the big cost of fraud in Lebanon is the amount of business that doesn't get done, because people don't do business with people they don't trust. In the book, and I'll move on to another slide, I kind of classify frauds into 4 generic types. And it's a classification that's based on trust because it's based on the kind of trust that the fraudster is exploiting. And they go up in levels of sophistication. So if you've got one person or one economic entity that is making the decision to trust you or not, then usually the scheme that you are taking advantage of is called a long firm. And that's goes back to the Anglo-Saxon period, that name, but it's basically a long firm is a con where you borrow money and don't pay it back, buy goods on credit and then disappear. Just basically take advantage of the time delay between receiving value and future settlements in order to steal by dishonest representation. You can move up a level of sophistication because long-firm frauds can take place in really quite primitive economies. As an economy gets more sophisticated, it develops means of certifying things, economizing on the checking up process by providing credit references or certifying the value of metals or providing bills of sale for goods and so on. And when you have those delegated checking systems, you can do what's called a counterfeit. You misrepresent something as being a claim on something of value in itself or certifying the value of something else. You exploit people's trust in the whole system. In general, people trust that a banknote can be exchanged in the old days for gold, in current days for bank deposits, and people don't check that the banknote in their hand isn't one that's been counterfeited. And that's a slightly more sophisticated, slightly more abstract fraud. As you get more sophisticated into the industrial age, economic entities get created which are too big for one person to carry around in their hand and control. If you control an economic entity, you can carry out a more sophisticated form of stealing, which I call a control fraud because that's the phrase coined by a bank regulator called Bill Black, who was the scourge of S&L fraudsters. This is an abstract fraud because it's one in which the criminality is in the whole scheme rather than in any individual action. If you have control of an entity, then it can pay dividends, it can pay bonuses, it can carry out transactions with the related parties. None of those things are illegal, and so no one's going to detect that a fraud is going on unless they realize that those transactions have in fact been carried out to benefit the party that's controlling it. Finally, you get to the very highest level of sophistication where there's not just kind of trust in individual entities, but you have economic entities like stock markets that are big enough to justify their own entire set of laws. These are interesting ones because there's lots of things which people don't necessarily intuitively consider to be crimes. You have to get almost to the stage of an undergraduate education before you understand why a cartel is a crime. Insider dealing on stock exchanges was a crime in the USA in 1934, was only criminalized in the UK in the 1980s, and was only a crime in New Zealand in 2008. These things are not really acts that a criminologist would recognize as a paradigm case. It's just a case where the internal rules of a particular market have become so important that it's been decided to turn them into crimes. At that point, a market crime is usually the most lucrative because you are planning a fraud on something that's big enough to deserve its own legal system. That's where you really start getting into the megabucks, and that's where a lot of the biggest frauds of the financial crisis were. So going on from that, you might think, how do these economics help you detect frauds? I've got in the book a golden rule for fraud detection, which I will now try to derive and justify. There are two things that almost all frauds end up having in common. First, they have the snowball property. This is, I don't like the word Ponzi because the general definition of a Ponzi scheme doesn't make any sense. People refer to something as a Ponzi scheme if it takes money in from new customers in order to pay out old customers. But that's true of loads of things. That's true of pretty much any economic entity that doesn't have perfectly consistent cash flows and exists over time. You know, if you're drawing down student loans and paying back a credit card today, then you are borrowing new loans in order to pay back existing creditors. There's also, I don't like giving Charles Ponzi any credit because, in fact, he was not the first Ponzi schemer. He was not even the first Ponzi schemer in the town of Boston. There was a lady called Sarah Howe who deserves that title. But the snowball property is real because fraud is an ongoing crime that involves that dimension of time. If you're a shoplifter, you can just decide that you're going to give up shoplifting. You know, if you're a drug dealer, you can say, I'm just going to stop dealing drugs today. If you are an embezzler, or if you are carrying out an accounting fraud or something like Enron, you have to come in and commit a new crime every day. This was one of the things that pretty much psychologically destroyed Jeff Skilling. He knew that the game was up, but the moment you stop faking those accounts, everything falls apart. So you have to keep on committing the crime even when you don't want to. It's like the reverse of a bad detective novel. If someone's murdered, then they're lying on the floor and you just have to say, who was it that stabbed them? In the case of a fraud, once Enron had been collapsed, it was pretty obvious whose fault it was. The trick was to understand that a crime had taken place. This is why they're ongoing. And in the world of business economics, something that is ongoing is also generally growing at the same time. Because profits grow at a compound rate, because something like assets in Bernard Madoff's fund grow at a compound rate, then when you drive a wedge between the real accounts and the accounts that you're showing to the investors or to the public or whoever, this wedge will also grow at a compound rate. If you have, this was the tragedy of Wirecard, in my view, which, the whole story of that company has not come out yet, but it looks like it went crooked pretty early. Then it took off and the legitimate business started to work, but you can't go back to being a legitimate business. The bug was in there, the canker was in the rose to begin with. It's always growing. And as the wedge grows, you can't go back to do anything without having a mega restatement that would have alerted people to the fact that you were criminals 4 or 5 years ago. That's one of the building blocks of fraud detection. At some point, any fraud is going to grow so big that it can't be concealed anymore. That's how Ponzi schemes end. The other trick about frauds is that they are designed around a particular control weakness. They're designed around particular differences between reality and the representation of reality that the management are taking. This means they're usually facades. They're usually stage sets which look very different when you look at them from a different angle. There's a wonderful book out called License to Steal. It's about 10, maybe even more than 10 years old, by a guy called Malcolm Sparrow, who is mainly a historian of the Medicare system. And being a historian of the Medicare system means you pretty much have to be a historian of fraud in the Medicare system, because throughout the 1980s, there was a reform in the Clinton years that reduced this somewhat, but it's still a big problem. But throughout the 1980s, it's credibly estimated that as much as 30% of the Medicare program was paid out to fraudsters. It took the banking system a while to win the title back of the world's biggest fraud. That's how big this thing was. It was hundreds of billions. And what they did was they exploited the fact that Medicare had been set up on the assumption that the problem in US medicine was overtreatment. And so all of the claims management systems were designed to detect overtreatment. They weren't designed to detect fraud, and so they didn't detect fraud. The computer systems weren't, for example, set up to recognize that you could have 1,000 claims for artificial legs coming in from people with 1 digit difference in their zip code. What the fraudsters did was a technique that they called shotgun then rifle, where you fire off in the shotgun phase, you fire off a load of claims that you think are going to look reasonably plausible. Some of them get rejected straight away. Some of them get rejected with a reason for the rejection. So to a large extent, Medicare ran a trading program for fraudsters by doing this. And some of them get paid. Once you've worked out which ones get paid, you switch from the shotgun to the rifle and you fire as many exactly similar claims through that hole that you made with the shotgun as you can. And the thing was, Medicare was set up to be efficient. It was set up to have the minimum average cost of processing a claim, but it wasn't something that should have been a cost managing system. It was a decision-making system, and it should have been optimized for making the right decisions, because at the end of the day, you get one fraud, and that just wipes out all the savings you made from saving 20 cents on 1,000 other claims. There were some insurers, and Sparrow writes about them in his book, that had claims rates that were literally less than a 20th of the median for Medicare claims expenses. And what they did was, firstly, they did not optimize. They wanted to pay the right claims rather than to pay all claims cheaply. And secondly, they did not standardize their processes, which made them pretty much invulnerable to fraudsters, because you could get one claim through when Bob looked at it, then your next claim through would be passed to Sally in the same office, and it would be looked at in a different way, and it would be rejected. So I think from those two phenomena, I put together what I call the golden rule. If you see something that is growing unusually quickly, it needs to be checked out, and it needs to be checked out in a way that it hasn't been checked out before. Visit the site on a weekend rather than a weekday. Call up the insurer rather than the port to see if a ship has sailed. Just do something to that thing that hasn't been done before and which might not have been included in the design of a fraud. I'm not sure that that's a kind of universal rule, but I think it would have caught most of the famous examples in my book. Speaking of those examples, what everyone wants is the stories. I've got, I think, something like 24 chapters in sort of past 1,000-word, basically, summaries of famous frauds of the past in the book. And these are some of the examples of the things you can do. Great Salad Oil Scandal was subject of a Pulitzer Prize winning book. Lots of frauds get really good books written about them, but the trouble is that the books go out of print within a couple of years, and then 10 years after that, inflation has progressed and the amounts of money that were stolen that were big news at the time seem pretty quaint. But the salad oil scandal was a guy called Tino De Angelis, who was the king of soya oil trading, wanted to grow his business much faster than he could do by honest means. So he started borrowing money from the American Express financing company, which was a much bigger deal in the 1960s than it is today. And he exploited the fact that I've got there on the slide. Oil floats on water. It's difficult for someone who's lending against tanks full of soya oil to check them. And if they put a dip into the tank and it only contains a few gallons of oil floating on a load of seawater, then they will end up lending against an entire tank of things. That was the equivalent of 1.5 billion US. And it would have been bigger news, except the whole thing fell apart on the same weekend that President Kennedy died. The Portuguese Banknote Affair destabilized the whole country of Portugal and basically ended up leading to the coup, which resulted in Portugal being a dictatorship for something like 50 years. It was, probably the biggest fraud in macroeconomic significance, because what happened was that the Bank of Portugal was in the habit of financing itself in a very modern monetary theory kind of way, printing off notes to finance expenditure of the Portuguese government that they didn't want to levy a tax for. The Bank of Portugal was also a private company, and it also had failed to invest in its print works, so it wasn't able to keep up with modern security features, and so it outsourced printing of Portuguese banknotes to a firm in London. A Portuguese fraudster called Arthur Alves dos Reis showed up in London with some Portuguese diplomatic credentials and a letter with the signature of the governor of the Bank of Portugal, which he'd copied off a banknote, and got the printers to run off, well, the equivalent of slightly more than 1% of Portuguese GDP in counterfeit notes that were perfect, undetectable counterfeits because they'd been run off using the same plates, same paper, and same ink as the real things. And he was very unlucky to be caught. It just happened to be that one day someone accidentally stacked one of his forgeries next to a real note with the same serial number, and one of the bank tellers noticed that this had happened. Russ Meyer's heating oil. Russ Meyer was a nasty guy in New York State in the 1970s who took engine lubricant oil, which has lots of really nasty impurities in it, into his system in New Jersey, took it across state lines into Pennsylvania, where it could be relabeled as heating oil, and then sold it in New York City as heating oil, resulting probably in getting in for 5 figures worth of deaths, just simply from the amount of heavy metals, PCBs and other carcinogens that people were pumping into the air in New York. He remains one of the only people to have done time for economic environmental crime. And I wanted to put that one in there because it shows that this stuff isn't just trivial, and it isn't just about robbing a rich people without violence. Fraud can be a crime of violence. That guy killed more people than the mafia ever did. We've got a few others on there, but I'm conscious of leaving time for comments. These are all great stories. Even the really nasty ones like Russ Meyer, you kind of get into the details on them, and I hope that it kind of livens up what would otherwise be a fairly theoretical book. Finally, I've got some comments here that I think didn't really fit into other things, but which might be kind of more relevant in an international political economy context. Firstly, you have the government, which is an unusual in the economics of fraud. It's an unusual victim of fraud because the government can't turn anyone away. A normal company can just decide it doesn't like the look of you or it's heard a bad rumor, but the government has to give a reason why it's not going to deal with you. It can't be part of any normal trust networks. And so in countries where you don't get much fraud because everyone only deals with their relatives, you will find there is a lot of fraud carried out against government. You will often also find out there is a lot of fraud committed by the government. I've got more of that, about that, coming out in the US edition of the book. Can't think why. Catching fraudsters is difficult. Bill Black, the SNL guy, is basically the only person I managed to find out after doing like 2 years of research for the book, who used to regularly catch fraudsters while he was looking for them and on purpose. And part of the reason for that is that he was an extremely tough guy who was clearly very difficult to deal with, as can be seen from his own book on the subject, which records him falling out with almost all of his colleagues. The biggest defense a fraudster has, and these certainly was something I experienced myself when I was covering European banking frauds, is that it's extremely difficult to look someone in the face when they say, "Are you saying I'm a liar?" and to tell them, "Yes, I think you're, well, not necessarily a liar, but I think in this case you are responsible for systematic fraud against the US tax system." It's sociologically difficult. It's psychologically, I think it's almost physically difficult, because as a species, there's considerable barriers to same species aggression, particularly against males of higher status. It's genuinely difficult to look at a CEO and accuse them of dishonesty. And that's why, in the consulting work, I think I once consulted with a bank that was famous for having a no assholes policy. And after we did some work with them, they recruited one guy whose job it was to basically be their asshole. And he was pretty good at it, I have to say. But he was the guy who was there to say, stop and say, actually, we're not all on the same page here. Actually, this isn't friendly. and unless this paperwork is done properly, the transaction's not going to go ahead. That's the kind of personality you need in fraud detection and credit control units, and it's pretty rare. I think the final thing I want to wrap up with, which is also the conclusion of the book, is that you can get a bit too moralistic about fraud. Something like a third of all the London Stock Exchange flotations in the 19th century were frauds. More or less every railway company to have been floated on the New York Stock Exchange was at some point in its life a fraud. But those railways did get built. You know, if you're looking at a history of 19th century Victorian England and all you're talking about is financial crime, you're missing the big picture. If you're looking at the dot-com era in the USA, only in terms of the securities frauds, of which there were dozens, you're missing the big picture. The internet boom did actually happen. The optimum level of fraud, as we say in the book, is it's not zero. In some cases, it might be quite high. So although you do need to be cynical, I will even go against my own last bullet point and say that you have to consider, do you want to have zero fraud or do you want to have development? And I think with that, I'll take the screen share off and maybe we can go to Q&A. I'll see what's showed up in the chat.
Excellent. Thanks very much for that. That's fabulous. We actually did have that in presentation mode rather than full screen mode, as a couple of people pointed out, but you could still see them.
Sorry.
I didn't interrupt. It wasn't worth it.
Thank you.
No problem. So we've got one question in so far, but I'm going to hold it because I want to just ask something first. And I want to get you to expand on something. There's a fascinating bit in the book about the dark net, Ninth Wonder, the Silk Road. And I'm thinking of Henry Farrell's wonderful essay about this stuff on basically the inability to do without the state, right? In a sense, these things try and police themselves. So we have this weird situation whereby a fraud is being committed, but the entire thing itself is a fraud. Can you unpack that example for us? Because it was just such a crazy story.
Yeah, I mean, the weird thing about Darknet is they did everything right. If everyone had played by the rules, then it would not have been possible to get ripped off while trying to buy drugs on the internet. Because the way that these markets used to work is that you put your Bitcoins, as it was, in escrow. And then when you received the drugs, you would send a message saying, I have received the drugs, and the money will be released to the seller. They had a pretty advanced dispute resolution system, which worked. And that was the Silk Road market. And the Silk Road market was a place where everyone got mightily ripped off because although that thing worked to prevent fraud, nobody used it. And the reason nobody used it is everyone had the classic small business problem that you've got delayed payments, which is a pain in the neck to finance, particularly if you're a drug dealer and the people who are financing your inventory are not necessarily people that you want. Yeah, they're the kind of people that you pay on time. And also you've got classic small business problem of revenues in one currency and costs in another, because you're taking Bitcoin in from the online drugs markets and you're paying out US dollars to whoever you're buying your drugs from. And that means you're exposed to price volatility on Bitcoin, and people hated this. And so what people did was they said, let's do a side deal. We won't use the escrow system. We'll just trust each other. And in general, what happened reflected the balance of power between buyers and suppliers in that market, which was that when people said, let's trust each other, they didn't mean, you deliver the drugs and trust me to send you the Bitcoin. They meant cash up front and you trust me to deliver the drugs. And so Silk Road, just basically everyone got ripped off all the time. On the other hand, it wouldn't have helped them much to have used the escrow system on Evolution, which was the market that got set up and took the market share once Silk Road got shut down by the feds, because it turned out that Evolution itself was run by fraudsters who took out something like $12 million from the escrow system, and everyone just logged in to the market and got, I think, a blank dark web page saying this market isn't here anymore. And they went around saying, what's happened to our money that's in escrow? And pretty quickly, they found out. So, I mean, these are crazy kind of episodes.
So I've got some great questions have come in now, so I'm just going to go straight to these. The first one's from Lawrence Mulcahy. Isn't catching fraudsters also due to an unwillingness to actually prosecute the fraud in a serious way? I think of examples like the US SEC going after small-time insider traders, while global banks like HSBC pay a fraction of the gains out of a fraud out of corporate coffers, while the C-suite walks away with their control and gains largely intact.
Excellent question. Making sure not to libel any international banks, although it is an absolute fact that HSBC laundered money through Mexico, and not only have they admitted it, they've signed an undertaking that they're not going to deny it. Got a lot of sympathy for that. We deal with it to some extent in the book. The interesting thing is that you want to prosecute people, but they have to meet you halfway by committing a crime. And the trouble with the big frauds is that they are control frauds. And as I was sort of said with some of the presentation, the nature of a control fraud is that usually the individual actions are not in themselves illegal. It's illegal to borrow money you have no intention of paying back. That's quite a straightforward one to prosecute. Insider dealing is a bit of an abstract crime, but it's easy to prosecute because there's a clear link between the action and the illegality. In a big control fraud, something like the robo-signing MERS system, which I go into a lot of detail in the US version of the book, or like payment protection insurance in the UK, there's a lot of individual illegal actions, and they're all carried out by people low down the chain who you feel really kind of bad for prosecuting because most of them were just trying to keep their job. The real overarching fraud is in the scheme of arrangements. It's in the big structure. And so it becomes incredibly difficult to prosecute because you start having to prove that someone was intending the effect, and proving that someone had the criminal intention is just exactly how fraudsters stay out of jail. One bit of advice, actually, is some advice you can use from this seminar series. If you take nothing else away, everyone gets one free go at a fraud, basically. Michael Levi, the best guy I've read writing on the criminology of fraud, said this. It's been confirmed by quite a lot of police officers. If you've got no previous convictions, if you are not seen to still have the money, and with exception for things prosecuted by financial regulators who have a system for these things, if it's your first fraud, you will get away pretty much scot-free. It's extremely rare to be prosecuted. If prosecuted, you will probably be found not guilty. If you're found guilty, you're extremely unlikely to do jail time. And the reason is that any fraud of more than minimal sophistication is going to look like a business deal that went bad. And the only thing that makes it a fraud is your dishonest intention, which is very difficult to prove. And for the big companies, the HSBCs, it's just a multiplied version of that, because linking the C-suite to the consequences of their actions is so difficult.
Cool. Thank you for that. Alec White has an interesting question, which I would call the cross-sectional versus time series question. So you suggested it's an equilibrium phenomenon. You can have countries like Canada, which are high trust, but you still have high fraud. And then you've got Greece, where basically have low trust, but you could actually have low fraud. He's asking a slightly different one. How does the current rate of fraud compare basically over the arc of history? Do we see more fraud now than before, or is it basically the same, just in different guises?
Interesting question. It comes in waves, basically, and it comes in waves per business cycle. In dollar terms, we're obviously seeing more, the global financial crisis contained the US mortgage robo-signing fraud, the LIBOR fraud. So, I mean, in headline numbers, there's no question about it. The 21st century is seen more, and probably more as a percentage of GDP than ever before. And it's simply because as you build more and more complex economic things, you build more and more things which need to be managed. You build more and more of an information gap, a sort of reduced information set between the control, and you build more opportunities for the thing. So I would say that compared to, I would say it's probably higher now than it's ever been, but it comes in waves. So it's probably lower now than at the period immediately before the global financial crisis. But if you kind of average through the cycle, then it's only it is likely to be only getting worse.
And so is it primarily pro-cyclical? Is it so? Then it's primarily pro-cyclical. Yeah.
Yeah. It's sort of, you find out about it immediately after the cycle has turned, and then at the cycle trough, people start pushing more things out there because there's more sales and there's more ways to conceal it.
No, it's kind of a Minsky cycle of fraud.
Exactly. Yeah. Well, I mean, Minsky actually names one of the stages of his cyclical theory, after Charles Ponzi.
The Ponzi, that's true. And moving on, Sumati Mitter asks, can you talk about the role of the state in enforcing and/or guaranteeing trust? Does the state do this, or is it, because you also make the point in the book that the state is the biggest victim because it's not part of these networks. So how does the state fit into this? Because when we think about high trust societies, at least I do, you think of the Scandos, they tend to have big states. There's an assumption that somehow that correlates with trust. How would you think about it?
The way I would think about it actually is there's a criminological model of fraud called the fraud triangle by Donald Cressy. And it's like the murder triangle, motive, means, and opportunity. For a fraud to come together, you need to have a need, which I suggest explaining in the book is that, bankers commit crimes for the same reason that heroin addicts do. Their lifestyle has got them to a position where they can't get that kind of money honestly. You have an opportunity, which is a control weakness or an exploitable weakness in the system. And then the third triangle is rationalization. Because the key thing about white-collar criminals is that they are not deviants. In order to commit the crime, they need to come up with a redescription of reality under which they are not still, while they are doing something bad, they remain not deviant citizens. So in a Scandinavian economy, or Canada, you have an egalitarian society. So you've got fewer needs. You've got a clearer state and a clearer set of norms, which are largely kind of set and enforced by the state. So it's more difficult to rationalize. It's more difficult to describe yourself as not basically deviant than it is in a place like Nigeria, or a place where you're seeing headlines about government corruption at the highest levels on television every day. It's not possible to think of yourself as a kind of normal, nice guy. And in societies like that, because you've really weakened the other two sides of the triangle, you can leave opportunities hanging around as much as you like. Somewhere like Greece or Lebanon or Nigeria, you've got lots of need. You've got high propensity to rationalize. You need to absolutely make sure you're not leaving any opportunities for fraud, or they're going to be taken.
Great. We've got some brilliant questions. I want us to continue. We've only got 10 minutes left. I'm going to ask Alex, who's running the tech side of this. Alex, can you shoot me a note if we can go over the hour? Because I really want to get through this because it's a very good discussion. I'm going to presume we can until we're told not. So here's an interesting one from Jeremy Fox, and I'm going to suggest that you give your Vioxx example here. In what ways does your framework for understanding financial fraud apply or not to fraud in other contexts? I'm a scientist, so I'm thinking of scientific fraud, for instance. You got a great example in the book with Vioxx, but you may have other ones.
Well, I mean, Vioxx is the clear thing, but again, it keeps happening again and again. If you look at the amount of precautions taken against fraud in the pharmaceutical industry, you know that they are attacking the opportunity side of the triangle so much that they must have a big problem with need and particularly rationalization. Vioxx was a drug marketed by Merck it was an anti-inflammatory. It had great properties for not causing gastric problems, which anti-inflammatories often do. It had terrible problems for causing heart attacks. The people responsible for Vioxx fell so much in love with the theory of, it was called cyclooxygenase inhibition, but the theory of their particular anti-inflammatory mechanism, that they just couldn't bring themselves to believe that this drug wasn't great. They started ignoring evidence. Anyone who's been in science or even social science knows how much you can fall in love with a theory. And once you fall in love with a theory, you're half of the way to developing a rationalization that what you're doing is not so bad if you put your thumb on the scales in terms of the evidence, or if you depart from what you would regard as ideal methodology in some way. And that happens all the time. And that's why there's so many controls that have to be built in there. And obviously, as we know from the replication crisis in social psychology and so many other scandals, that's why these things do happen all the time. I don't think it's particularly different from financial fraud. I didn't write about it much in the book outside of the pharmaceuticals industry, but that's mainly just because I sort of didn't know it as well as I know finance.
Right. One that's come in from YouTube that I want to get to. Last year, there was that famous paper, I'm sure you saw it, that said that around 40% of global FDI was essentially tax dodges. And Charles Ritter asks, what percentage of international trade is fraud? You might not know the actual percentage, but trade economics is a problem whereby there's no observed specialization. At the same time, FX volume is out of proportion to the trade. How do we make sense of that? Is that a signal of fraud?
Well, FX volume as a proportion to trade is a little bit kind of different, and to a large extent reflects the fact that FX traders will bounce orders around in order to square up their book. So you can put in a 10 million US order and it's going to get split up into 10 1 million US orders, which themselves are going to bounce around until they find a final buyer. I wouldn't necessarily take that ratio as indicating fraud, but yeah, no, I saw the paper on FDI. There's an awful lot of trade which exists as overbilling, which is also basically a tax planning strategy. If people want to argue about how much of that is fraud versus how much of that is legitimate payment of royalties to companies in tax havens, then that's a debate I'm perfectly happy to have with a glass of beer in my hand until I offend someone. But I mean, there's also an awful lot of shipping is fraud. An awful lot of ships are reported as sunk and then get moved to a different port, repainted, and go back into service. There's an awful lot of cargo fraud. One thing we discovered actually during the coronavirus pandemic was that the soybean oil scandal is still going. 2 or 3 major European banks just quit the commodities finance business in the last month because they'd lost hundreds of millions of dollars on inventories of soft commodities that turned out not to exist. Wow. And didn't exist. They only found this out because COVID affected the world patterns of trade. And as a result, stuff didn't get rolled over and people wanted to take delivery of some cargoes. And it turned out that the cargoes didn't exist. And a bunch of soybean traders operating out of Singapore effectively just went hands up and disappeared. And as a result, I think ING Commodities Finance has gone. ABN AMRO is getting out of commodities finance. There's a bunch of European banks that have fallen prey to, as I say, replicated across time and space. It's the exact same scandal that happened in 1963.
Wow. Bradford Gibbs has a really good one. Here we go. Spoofing hit the headlines a few weeks ago, given the fine levied against JP Morgan. There has been commentary that while surely a form of market manipulation, this seems like a kind of victimless crime. As one trader mentioned, they were simply trying to juke the algos as opposed to widows and orphans. Spoofing targeted high-frequency traders for whom limited love has been lost. So is this still fraud, or is this basically just the rules of combat in high-frequency trading?
It's a market crime. It's a perfect example of what I mean by a market crime. Spoofing in the sense of putting in more of a bid for something than you necessarily want in order to see what happens to the price. In some markets, it's just simply the normal way to operate. There's something I wrote actually, but ended up on the advice of my editor removing from the book. which is if you ever think of the way that you buy underwear, then it's just crazy to a securities regulator. The shop fixes the price of underwear to maximize the profit for them rather than reflecting the true balance of supply and demand. They have more information than you do about the market for underwear, and lots of it is non-public. These are things that would make a securities regulator absolutely explode with rage. Spoofing, for a long time, people didn't think was a crime, and that's why they did so much of it. The thing about it is that these markets are set up to encourage as much participation as possible. As a result, they have internal rules which say that some behavior by informed or smart traders is acceptable, like going out and reading 10K reports or reading commodities reports. That's okay. Some kinds of activity is acceptable but managed, like high-frequency trading, like code location of servers and high-frequency fiber links. And then some of it is just out because it's considered to give too much of an advantage. It's like doping in sports. You're allowed to have super light running shoes, which is a technological aid. You're allowed to employ a professional coach, which people in developing countries can't necessarily do. You used to be allowed to have those crazy swimsuits that held your body into an aerodynamic shape. You're not allowed to take artificial testosterone. A line has been drawn. If you know about the line and cross it, then I would say that's a crime, that's fraud. But, I'm not going to if someone's lined up in the pillory for spoofing orders, I'm not going to be up there throwing fruit at them. I don't think it's necessarily a crime. And that's the nature of the thing. It's a market rule that's been raised to the status of a crime.
So shifting it to a very different part of the world, Dan Smith asks the following. I work in Nigeria, a country notorious for fraud. While Nigerians lament the problems of and reputation for fraud, they also sometimes celebrate fraudsters for turning the tables on rich countries and or rich people who have in some senses defrauded Africa for centuries. I guess my question is, how do you think about the boundary between what is legal fraud and other forms of exploitation and enrichment that garner, at least for a while, a veneer of legitimacy?
Well, yeah, I mean, I've got something about this coming out in the US version. It's not in the British version. Look, if you look at the typical Nigerian fraud, it's absolutely Nigerian. It's as Nigerian as groundnut stew. It's a communications fraud. The origins of the 419 advance fee scam was when Nigerian fraudsters realized they could forge postage stamps cheaply, so they could send letters back in those days to companies in there. It's in general committed against people in the USA, in the English-speaking countries, the former colonial power. And it's in general done by impersonating a corrupt tax collector, which was, one of the main ways in which Nigeria's mineral wealth was exploited. It's absolutely something that only could have been invented in Nigeria. So yeah, I've got a lot of sympathy for that point of view. The other interesting thing is that if you ever read a Nigerian advance fee fraud email and it looks extremely badly written in English, the chances are that the person who wrote it can write much better English than that. They write it in a particularly illiterate style because they're not interested in being read by people who are smart enough to spot that it's semi-literate. If a guy like yourself reads one of their emails, then that's time wasted for them. They want someone dumb to read. Right. So they actually use that as a filter. That if you're smart enough to spot it, they don't want to talk to you. So they write it in a style that if people who are that smart will immediately delete.
Thank you for explaining something. About a month ago, I posted one on my Twitter feed, which was this astonishingly badly written internal memo from the Federal Reserve, where apparently Ben Bernanke, who's no longer there, and Bill Dudley, in broken English, were determined to give me $10 million.
Yeah.
And now explains, but that's obviously not for me, that's for somebody else, right?
Yeah, it's for someone who would be fooled by it.
That's fabulous. We're actually we're just over the hour now, and we've got one question left, so this is a wonderful session. Thanks for this. Patrick Coast asked the last one, which is related to the Nigeria question in a way. You talk of the optimal rate of fraud, which, greater than zero, right?
Yeah.
What is the relationship between fraud and development? Is it stagnation at lower rates, development at optimal rates, and failed states at high rates? Or should you think about it some other way?
I think probably should we think about it some other way that I don't necessarily know what it is. Optimum level of fraud is not zero is pretty much the only statement I'm able to support there. There's clearly a variety of different outcomes and equilibriums. Widespread fraud has certainly been used as a development strategy. That's the story of former communist Europe. And the debate over whether that was the best idea or not goes on and on and on. It's tough. The thing is that actually in most of the cases where you've had very high levels of dishonesty with very high levels of growth, it was the growth that came first. You didn't get railroad frauds in the very early days of the railroad boom. The dot-com frauds came in the late stages of the dot-com boom. They certainly persisted together for a long time, for potentially a very long time. But I don't think I've seen a place where things started off in theft and then got better. That's just prejudice. I don't think we've got enough data points to make any statement other than the one which I will defend, which is that the optimum level is not zero.
Excellent. Well, as you can probably see, my dog Lucy has decided to bust the set, start dropping balls all over the place. Just so you can see, there's Lucy there. There she is with the ball in her mouth. That's it. So that clearly means it's time up. I'd like to thank Dan for talking to us today. We're about to go now and record the podcast for the Road Centre. So if you want to follow up on this, we'll be posting this probably within about 7 days. But it's been a great event. Thanks to everybody for coming in and the great questions. And I look forward to seeing you next time. All the best. Bye-bye.
Thanks very much, Mark.